All right, tonight we continue with our discussion, Divisional Performance Evaluation. Last week, we introduced the topic, Divisional Performance Evaluation. What is this topic all about? This topic is about how to evaluate the performance of a company that is operated along divisional structure. We use the example of Dangote Group of companies. This company is operated along divisional structure. Under the Dangote Group, we have Dangote Cement, we have Dangote Transport, we have Dangote Foods, Dangote Drinks. We also have Dangote Petroleum. Now, the different divisions contribute to the total profit of the company. The question is, how do we evaluate the performance of division? We explained last week that where a company is operated along divisional structure, there could be several benefits. One is it could increase decision-making process. It provides better training ground for junior managers. However, there could be some risk with divisional structure. Some of these risks are increased overhead costs, duplication of common duties, loss of control, the risk of suboptimality. We discussed this. We now said to minimize this risk, a company that is operated along divisional structure must introduce an appropriate performance evaluation method. If a company is operated along divisional structure, the company must introduce an appropriate divisional performance measure. We explained that there are two types. There are two major types of divisional performance measure. We have financial performance measures, and we have non-financial performance measure. Last week, we focused on financial performance measure. Under the financial performance measure, we discussed return on investment, that is return on capital employed, as a basis for measuring performance of division. We equally discussed residual income as a basis for measuring performance of division. Thereafter, we solve a question. Within the time permitted, we solve a question. Tonight, we shall continue with financial performance measure, and precisely we shall be discussing economic value added, EVA. Economic value added as a measure of performance. Now let's explain the concept. We are going to be discussing what is economic value added, what is the formula for calculating economic value added, then how do we calculate economic value added. First, what is economic value added? as a metric for divisional performance measure. Economic value added is very similar to residual income. However, it uses economic profits, not accounting profits. And it uses economic capital employed, not accounting capital employed. Economic value added as a performance measure can be used to measure the performance of an organization or the performance of a division. And it is based on the principle that performance of a division or performance of an organization should be measured in terms of value that has been created to the business. I will repeat that. Economic value added is based on the principle that if you are trying to measure performance of a company, or you are trying to measure performance of a division, you are going to measure performance in terms of value contributed to the business. What is the value created by the division? According to economic value added, accounting profits does not represent the true value of a company. If you look at accounting profits does not tell us the value that has been created for the shareholders, because accounting profit is prepared based on assumptions and convention. What are these assumptions? One is that if you prepare your accounting profits, we make provision for depreciation. When you are making provision for depreciation, this does not involve cash flow. That means you are creating a distortion in value by making provision for depreciation. This depreciation will be deducted from your profits. That will reduce your profit. Depreciation is a non-cash item. Non-cash item does not constitute value to the business. Also, we make provision for bad debt or provision for doubtful debt. All these provisions are accounting conventions. They do not represent economic reality of the performance of a company. This is what economic value added tries to explain. In calculating economic value added, you are going to disregard accounting assumptions and convention. You are only going to look at those items that created value to the business. In other words, items that involve cash flows. These are the items that we will consider when calculating economic value added. And let me add that economic value added is directly linked to the objective of shareholders' wealth maximization. Just 1 minute. Let's continue. Look at the last point I've added. Economic value added is directly linked to the creation of shareholders' wealth. So this method of evaluating performance is superior to residual income and is superior to return on capital employed because it uses value, not accounting profit. All right, we have explained the meaning of economic value added. The next discussion is how do we calculate economic value added? Please look at your screen. To calculate economic value added, the formula is net operating profit after tax minus, we call it adjusted capital employed, minus, open a bracket, adjusted capital employed multiplied by the cost of capital. Or you can use the abbreviation. The economic value added is calculated as NOPAT, net operating profit after tax, minus adjusted capital employed multiplied by the weighted average cost of capital. Your work. Now, this is the formula for calculating economic value added. So we now go to it. How do we calculate net operating profit after tax? How do we determine the adjusted capital employed? Then how do we calculate the weighted average cost of capital? These are the three items required to calculate your economic value added. So we start with our calculation of notepads. How do we calculate notepads? Please look at your screen. The format is provided for us. Notepads is calculated from profit after tax. Look at it in more details. To calculate your notepads, you start with the profit after tax, then items to be added. Items to be added back. Please look at the board. Look at the board. You are going to add back accounting depreciation, add back. You are going to add back provision for doubtful debt. You are going to add back. Also, you are going to add back provision for deferred taxation. Provision for deferred tax. If there is deferred taxation in the question, you are going to add it back. And all provisions must be added back. If you look at it, accounting depreciation does not represent a cash flow, and that will distort performance evaluation. Provision for doubtful debt, provision for deferred taxation, all provisions. This has not happened really. We are only complying with accounting convention. So you are going to disregard all provisions. Next, non-cash expenses or non-cash items. Non-cash items will be added back. Next, interest net of tax. You are going to pick the interest. Then you are going to deduct tax. The interest, that is your finance cost or finance charges. This will be added back because we are trying to determine value to the provider of capital, people that have contributed money. Now, your interest is already included Why are we adding back interest? Why are we adding back the interest? That interest is already included in the cost of capital. Your cost of capital includes cost of equity and cost of debt, cost of borrowing. The interest has been included in the cost of capital computation. So deducting the interest again will amount to double charges. All right. Also, add back items that add value to the business. What are these items? If there's goodwill, if a company has goodwill, and this goodwill can be quantified in value, then you are going to add back the goodwill. Goodwill amortized, add back. Research and development cost. If a company should engage in research and development, that research and development will create value to the business. So you are not supposed to deduct the cost incurred at once. The cost should not be treated as an expense at once. You are going to add back development and research costs. Then if there's operating lease cost, if you incur cost on operating lease, that cost should not be treated as an expense. Rather, it should be capitalized. You are going to add back the operating lease expense, and the asset will be capitalized. These are the items to be added back to your profit after tax. Next, items to be deducted. Items to be deducted. One is economic depreciation. Economic depreciation should be deducted. Number two is amortization of development costs. This is missing here. Amortization of development costs. Development costs. Now, what do we mean by amortization of development costs? If a company incurred costs on research and development, you are trying to develop a new product. Our company is trying to develop a new product. We're now going to research. We now incur costs. And after we have developed the product is now ready for marketing. That means when we market the product, we are going to generate revenue. That cost should not be expensed at once. That cost should be spread over the number of years. You are going to derive benefits from the new product. If that product will give us revenue for 5 years, then the development cost incurred must be amortized for 5 years. That is spread for 5 years. We're not trying to match relevant revenue with relevant cost. Under the matching concept, we try to match the revenue derived from the products developed against the cost of development. That is what is meant by amortization of development cost. Lastly, impairments in goodwill. Now, if there's impairment in goodwill, that means the company goodwill should reduce. that reduction should be deducted. These items will be deducted. Then you are not going to have your notepad, net operating profits after tax. This is how to determine your net operating profit after tax that is required for the calculation of economic value added. All right, next discussion. Next discussion is how to calculate, okay, it's missing here. How to calculate adjusted capital employed. Our next discussion is how to calculate adjusted capital employed. Let me demonstrate this with, let me go to the whiteboard. Let me explain how to calculate adjusted capital employed. Let me show the formats. If you have to calculate your adjusted capital employed, let me pick my pen or my electronic pen. Please look up. Let me create a space here. Or let me go to the whiteboard directly. Let me go to the whiteboard directly. Yeah, let me use it. Okay. If you want to calculate your adjusted capital employed, your 2 naira sign, you start with your opening capital employed. Start with your opening capital employed. Items to be added. One is non-capitalized lease assets. This should be added. 2, non-cash item. This should be added. 3, any increase in provision. This should be added. All these 3 items will be added. One, two, three, give you this figure. Items to be deducted. Any decrease in provision. This should be deducted. Then the balance will now give you, balance figure you have here will give you your adjusted capital employed. This is how to derive your adjusted capital employed. Then the last thing to be calculated is WACC, weighted average cost of capital. In some questions, the examiner will give you the cost of capital. In some questions, the examiner will ask you to calculate it yourself. So how do we calculate this ourselves? The WACC is calculated as cost of equity multiplied by percentage of equity, close this bracket, plus open another bracket, after tax cost of debt multiplied by percentage of debt. This is how to calculate your weighted average cost of capital. Please note, examiner will always give you the pre-tax cost of debt. Examiner will always give you the pre-tax cost of debt. Then you are now going to calculate after-tax cost of debt. You have to calculate that. Let me show you again. After-tax cost of debt is equal to pre-tax cost of debt multiplied by, open a bracket, 1 minus the tax rate. Please, if it is possible, document all this in your book. This is how to calculate economic value added. All right. We have taken the first 30 minutes to explain. Let me quickly add that if you go back to last diet question, last diet PM question, what examiner asked will interest you. Examiner asked a question on economic value added. Examiner says, explain the process or the procedures for calculating economic value added. 10 marks. Look at the question. Examiner didn't say calculate economic value added. The examiner says explain the steps or the procedure for calculating economic value added. What are you going to say now? You are going to tell the examiner that one, to calculate economic value added, we need to determine the net operating profit after tax. Net operating profit after tax is determined by taking the profit after tax, add back accounting depreciation, add back provision for doubtful debt, add back provision for deferred taxation, add back other provisions, add back non-cash items, add back interest paid of net of tax, add back research and development costs, add back goodwill, amortized. Then deduct economic depreciation, deduct amortization of development costs, deduct impairments of goodwill. We are going to list this out. What am I trying to say? This format I've given you, it is what the examiner tested for 10 marks last time. Please, we don't know what the examiner will text. Our duty is to, as much as possible, prepare the students adequately for the exam. All right? Any question, please? While I wait question, please go to page 115, question number 6. We are starting with that question tonight. Go to page 115, question number 6. We are starting with that question tonight. Please confirm you are in that page. The question is Uzochuk's Nigerian Limited, page 115, illustration 6. Page 115, question 6. We are looking at Uzochuk's Nigerian Limited. Please confirm you are in that page so that we can start. We can demonstrate what we have explained. You can confirm by a chat if you are in that page, page 115.
Hello, sir.
Yes, are we good to go now? Hello, are we good to go? The class is silent.
You can continue,
Yes, sir.
sir.
We can move on.
All right. Uzochuk's Nigerian Limited is a company established 4 years ago to produce medical equipment. The income statements and statement of financial position for 2019 and 2020 as follows. Look at the income statements. We have the sales for 2019-2020. We have the operating cost. We have the operating profit. Please remember, your operating profit is also your profit before interest and tax. Please don't forget. We have the finance charges. Please don't forget. Your finance charge is the interest cost. We have the profit before tax. We have profit after tax. We have the tax. The tax rate is 25%. Then we are given the statement of financial position. We have the non-current asset, current asset, total assets, shareholder funds, long-term long-term and medium-term debt, current liabilities, other information. 1. Operating costs include the following. For 2019, 2020, you have depreciation, doubtful debt, research and development, other non-cash items. Next, accounting depreciation is assessed to be 50.5 million in 2020. Economic depreciation includes any appropriate amortization adjustments. In previous years, it can be assumed that economic and accounting depreciation were the same. Note number next. Tax is paid. Tax is the cash paid in the current year, 16 million. And an adjustment of 2 million for deferred tax provisions. There was no deferred tax balance prior to 2020. Next, the provision for doubtful debt was 2.5 billion on the 2020 statement of financial position. Next, research and development cost is not capitalized in the account. It relates to a new project that will be developed for 5 years and is expected to be of long-term benefits to the company. 2020 is the first year of the project. Next, the company had a non-capitalized lease asset of 18 million in January 2020. These assets are not subjected to depreciation. Next, the cost of capital of Uzochukwu is equity 18%, debt pre-tax 6%. The capital structure of Uzochukwu, we have gone too far. The capital structure of Uzochukwu. Equity 60%, debt 40%. Then the last note, the company had the opportunity to invest in a solar project that required the procurement of an equipment worth 3 million naira in January 2020 and run for a period of 5 years with a salvage value of 0.5 million, generating a stable net cash flow of 0.85 million. The applicable cost of capital is the associated weighted average cost of capital of the company. Requirement A, compute and evaluate the performance, the company's performance using average rate of return format. Let us start with that. We are required to evaluate the performance of Uzochukwu using average rate of return. Now the question will be, What is average rate of return? Then how do we calculate average rate of return? Please, in exam, as much as possible, try to be able to explain the requirement to yourself. What is average rate of return? Please note, average rate of return is the same as return on investment.
Okay.
It's also the same as return on capital employed. Examiner can ask you to calculate return on capital employed, return on investments, or you may be asked to calculate the average rate of return. So what is the formula for calculating return on investment? The formula is, let's go to the whiteboard. Please, you are in this class. It's not a crime to copy in the class. Whatever you will do to make you to be active in class, average rates of return, in brackets ARR. The formula is average operating profits
minus
divided by average capital employed multiplied by 100. Now, remember, you are giving 2 years financial information. So you need to calculate average operating profit, working one. You can leave a space, my working one. I want to calculate average operating profit. Now go check the question. What is the operating profit for 2019 and 2020? 2019 operating profit, what is the value?
70.
70 million. And this is 80 million. Please sum the two together. We now need to look for the average.
Yeah.
Look at the average. Our average operating profit is equal to 70 million in 2019 plus 80 million in 2020. Then look for the average. That will give us
750.
No, sir, 75.
Sorry, I meant to say 75. Sorry, sir.
is 75 million, sir. You have gotten your average operating profit. You're working to calculate average capital employed. Please, how do we calculate capital employed, please?
Non-current asset
How do we
plus
calculate capital employed?
non-current asset plus working capital.
That's correct. You can do like this, please. Your capital employed is calculated as total assets minus current liability. Now go to 2019. What is the total asset value? You are supposed to open the question
540,
on your
sir.
system. How much?
540 million for 2019.
540 million minus current liability. Check 2019. What is the current liability value?
40 million.
That means capital employed in 2019 is
500 million.
500 million. Then go to 2020. What is the total asset value?
700 million.
700 million minus current liability.
155 million.
155 million. Capital employed in 2020, how much?
545 million.
545 million. Then we now need to look for the average. Average capital employed. Our average capital employed is equal to, for 2019, 500, for 2020, 545, divided by 2. What is the average value, please? Please reconfirm this.
422.5.
Correct. You can now calculate your average rate of return, which is equal to average operating profit, 75 million, divided by average capital employed, 522.5 million, multiplied by 100. Please find the percentage.
Hello, sir.
Yes, sir.
14.35.
Average capital employed is 422.5.
422.5. Please recheck your figure, please.
No, sir, it's 522.5.
Okay, that is 545. Okay, sorry.
So your average rate of return is 14.25. You have addressed requirements A. You have answered requirements A. We move to requirement B. We move to requirement B. Requirement B says compute and evaluate the company's performance using economic value added parameter. So you have to calculate and evaluate company's performance using economic value added parameter. If you are faced with question of this nature, take the formula out to yourself. Requirement B. Calculate economic value added. So I will take the formula. Economic value added is calculated as no parts minus, open a bracket, adjusted capital employed multiplied by the WACC. This is the formula for calculating economic value added. You now come here, the first working one, calculation of no parts. Please, you can look at the format. It's available on your study pack. You can go to the format. Let's follow. Now, before we go ahead, you are aware you are giving 2 years. You are giving 2019 financial information. And you are giving 2020 financial information. The examiner didn't tell us whether to calculate ever for 2019 or to calculate ever for 2020. In this case, you are going to calculate for the most recent financial year. If you are giving 2 years information, 2 years financial information, and you are required to calculate ever, please, you are going to compute ever for the most recent financial year. In this case, we are going to calculate ever for year 2020. That is the most recent financial year. So please go to the question. Focus on year 2020 financial information. Pick the profit after tax. Please check it. What is the profit after tax for year 2020?
48 million.
Pick it, 48 million. Then items to be added. Thank you. One is accounting depreciation. Go to the additional notes. What is depreciation for 2020?
28
28
million.
million.
28 million. You are going to pick that figure. Also check, what is the provision for doubtful debt?
1.2 million.
Pick that figure, please, and add back. 1.2 million. Now look at the notes. Do we have provision for deferred taxation?
There was no deferred taxation balance prior to 2020.
Go and read that note completely, please.
IIN.
Is the cash paid in the current year, 16 million.
All right. Good.
We have
And
two.
adjustment of 2 million tax provision.
Adjustment of 2 million deferred tax provision. That adjustment of 2 million should be added back.
Okay.
That adjustment for the provision for deferred tax. The actual amount paid as tax is 16 million. However, the company adjusted its figure to make provision for deferred taxation of 2 million. That 2 million naira should be returned back to the profit. Next, do we have non-cash items?
Yes, 3 million.
Add it back, non-cash item. Next, do we have interest? That is the finance charge. Interest net of tax. Now, what is the finance charge for 2020? What is the finance charge for
14
2020?
million.
14 million.
14 million. That 14 million, that is the interest cost. Out of that 14 million, you are now going to deduct tax. What is the tax rate?
25%.
Now look at how to undo it. The finance charge 14 million multiplied by net of tax, 1 minus the tax rate. The tax rate is 25%. This will give you interest net of tax. You pick the finance charge. You now net off the tax. To do this, just say 1 minus the tax rate. That will net off the tax. The balance is the interest net of tax. Please compute.
I don't know if I'm correct. I have 10,500,000.
What do you have?
10,500,000.
10.5 million. We have taken accounting depreciation. We have taken provision for doubtful debt. We have taken provision for deferred taxation. We have taken non-cash item. We have taken interest net of tax. Look at the question. Do we have research and development costs incurred in 2020?
Yeah, I think so.
Please go and check.
According to the additional information, research and development is not capitalized in the accounts. It's related to a new project that will be developed over 5 years and is expected to be long-term benefit for the company. 2020 is the first year of this project,
Okay, go to the operating cost. Look at note number 1. Do we incur development cost in year 2020?
No, sir.
No, sir.
Development cost was not incurred in year 2020. The development cost was incurred in 2019.
Yes.
In this case, you cannot add it back to year 2020 profits because that cost was incurred in 2019.
All right.
In this case, you cannot add it back to year 2020. The other note you read, we are still coming back to it. That is amortization of development cost. We are still coming back to that. So these are the items to be added. Please sum up 28 plus 1.2 plus 2.0 plus 3.0 plus 10.5. What is the total amount, please?
44.7 million.
44.7 million. This amount will be added back. We now move to items to be deducted. Items to be deducted. One, you have economic depreciation. Check note number 1 or 2. What is the economic depreciation?
50 million.
50.5
million.
50.5 million. This item will be deducted. Now, that note you read, development cost is not capitalized in the account. It relates to a project that will be developed for 5 years and is expected to be of long-term benefits to the business. 2020 is the first year of the project. In this case, the cost was incurred in 2019 and the project will be for 5 years. We are now going to amortize that cost for 5 years. When we say amortize, you are going to spread the cost. For the number of years, the benefit will be derived. Look at how to do it, please. Amortization of development cost. The development cost is 5 million naira. Amount is 5 million. And the benefit is for 5 years. This cost will be spread for 5 years. 5 divided by 5, that will give us 1 million. 1 million naira will be charged to year 2020 cost. That is what we refer to. That is how to amortize development cost. So these are the amounts to be deducted. If you add up, we are going to deduct 51.5 million. You can now get your NOPAT. You have 48 million plus 44.7 less 51.5. That will give you your net operating profit after start. Please add and deduct as appropriate.
41.2.
So you are going to have a balance of 41.2 million. This is your no parts. When you are done with working 1, you move to working 2. Calculation of adjusted capital employed. To do this, you have your Naira sign. You start with opening capital employed. Remember, you are trying to calculate for year 2020. Adjusted capital employed for year 2020. Now, what is the opening capital employed? Your 2019 capital employed is closing for 2019. It becomes opening for 2020. We have computed this before. Look at here, please. Look at here, please. 2019 capital employed, 500 million. That is the closing capital employed for year 2020, for year 2019. And it becomes the opening capital employed for year 2020. You are going to pick that figure. Come here. $500 million. Now, items to be added. Items to be added. 1. Go and check the question. Do we have non-capitalized lease assets?
Yes.
This item must be added back.
It's from figure 5.
Thank you. Non-capitalized leased asset. What is the value, please?
18 million.
18 million. We are going to add this amount. Number 2, do we have non-cash item? Yes, we
do.
That is 3.0.
3 million.
Thank you. Now, do we have increase in provision or decrease in provision? If there's increase in provision, you are going to add it. Increase in provision to be added. Please look at that note number 3 or so. Examiner says the provision for doubtful debts is 2.5 million on the statement of financial position. Can we see that statement, please?
Yes, sir.
Can somebody read, please?
The provision for doubtful debts was 2.5 million on the 2020 Statement of Financial Position.
Good. Now,
That's all.
if you compare this 2.5 million, now please compare this with the provision for doubtful debts in the income statement.
The one there was
Go and look at operating cost.
It was 1.2, sir.
Good. Now, the provision in the income statement is 1.2. Why the provision in the statement of financial position is 2.5 million? That means there's increase in provision. Hello?
Yeah, with you, sir.
That means there's an increase in provision. In the statement of financial position, the provision was 2.5 million. Why in the income statement, the provision was 1.2 million? That means the company has increased provision by 1.3 million. Is that not, please?
Yes, sir.
That increase in provision is in your balance sheet. The statement of financial position, that is the balance sheet. That means the company has increased provision in the balance sheet. The provision in the balance sheet is more than the provision in the income statement. That increment must be added back to your capital employed figure. The differences, we can show the differences. That will give us 1.3. That is, you have 2.5 in the statement of financial position minus 1.2 in the income statement. That is the increase in provision. These three items will be added back. This will give you 22.3 million. There is no decrease in provision in this question. In this question, there is no reduction in provision. You can now get your adjusted capital employed. 500 million plus 22.3. This will give us 522.3 million. This is the adjusted capital employed. You are done with working 2. Then the last working 3. Calculation of weighted average cost of capital. WACC. The calculation of weighted average cost of capital, just refer to the formula.
Cost of equity multiplied by percentage of equity.
Thank you. Our WACC is equal to cost of equity, the cost of equity multiplied by percentage of equity, close the bracket, plus open another bracket, after tax, cost of debt, multiplied by percentage of debt. This is how to compute the weighted average cost of capital. So let's go to the question. What is the cost of equity?
No, closer.
18%.
Yes.
What is the pre-tax cost of debt?
Tax 6%.
They say 6%. That means you need to calculate after tax. You are giving pre-tax. So you need to compute after tax. Just 1 minute. Can we expand this? Let's see if we can expand this. Otherwise, we continue like that. If it's not a problem. Let me see if I can expand this.
We have created
Yeah, we can expand it.
We need that to calculate the space for calculation.
Okay, he's taking it the other side. I'll do it small. Oh, yo. I should even be able to have it. Do I have it? Let me see. So, right here it. Yeah. Okay, we have tried to expand this. I'll just take this off. Okay. I'll take this off. I don't need this here. Let's continue. So I'll come here. This is, let me check the charts. So we are giving pre-tax cost of debt. So I need to calculate after tax cost of debt. Look at how to calculate it. After tax cost of debt is equal to, pick your pre-tax 6%, multiply by 1 minus the tax rate. This is how to calculate cost of debt net of. You can also call it cost of debt net of tax or after tax cost of debt. Please compute your after tax cost of debt. What is the percentage of equity in the question? What is the percentage of debt? Please check. Hello, we are waiting. Where is this guy, sir?
What was the question, sir?
Alexia.
Yeah.
I said,
Yes,
what is the percentage of equity in the question?
18%.
60%.
Thank you. Percentage of equity is 60%.
Okay.
Percentage of debt is 40%. Now, please compute. After tax cost of debt, 6% pre-tax, multiplied by 1 minus the tax rate. What is the figure here?
0.045.
That is 0.045. That is in percentage 4.5%. You have gotten all the variables required to calculate WACC. Our WACC becomes, pick your cost of equity, 18%, multiplied by percentage of equity, 60%. Close this bracket. Plus, open another bracket. After tax cost of debt, 4.5%, multiplied by percentage of debt, 40%. Please work this out. What is the WACC? Please work this out. What is the WACC?
$2.58.
2.58?
Yes, sir.
That can be correct.
0.0288.
0.0288. It's not possible.
0.126.
Yeah. 0.126. That is the figure you are going to get. If you want to convert it to percentage, multiply by 100. The WACC will give you 0.126 multiplied by 100. It becomes 12.6%. Please check your computation. This is the correct answer. You can now calculate your EVA, economic value added, equal to, pick the value for NOPAT, 41.2 million, minus, open a bracket, pick the value for adjusted capital employed, 522.3 million, multiply by, pick the value for WACC, 0.126. Please compute. What is the economic value of this company? Please compute. What is the economic value added generated by this company?
24.6.
24.6 million. Negative or positive?
Negative, sir.
24.61.
Negative.
Negative, sir.
Negative sign. Negative 24.6 million. Please note, if your answer is negative, that means the company is destroying shareholders' wealth. That company is performing poorly. What it means is that this company has destroyed 24.6 million of the wealth of the shareholders. Negative ever is an indication that the wealth of the shareholder has been reduced by 24 points. You can comment. A negative economic value added of 24.6 million implies that the wealth of the shareholders has been reduced by 24.6 million. The company has performed poorly. The company has performed poorly in year 2020. We are done with requirement B. We are done with requirement B. Question, please. We can look at the last requirements. We can look at the last requirements. The last requirement is on another topic entirely. Look at requirement C. Examiner says, calculate the net present value of the solar project for the life of an investment. 7 marks. Let's look at the solar projects. Look at the last note, please. Note number 7 or note number 8. Examiner says the company had the opportunity to invest in a solar project that will require the procurement of an equipment worth 3 million naira in January 2020 and run for a period of 5 years. with a salvage value of 0.5 million, generating a stable net cash flow of 0.58 million. The applicable cost of capital is the associated WACC, weighted average cost of capital of the company. Now let me ask the whole class, what is net present value? I want to believe this is not the first time we are hearing net present value. What is net present value? This will happen under investment appraiser. I don't know if you have gotten to investment appraiser with you.
Not yet, not yet.
Not yet. So what should I do? Should we leave this question until you get to Juwon's side?
Yeah, you can leave it.
Okay, let's leave it so that I don't distort what we are learning today. Today we are focusing on economic value added. We have like 20 minutes, although the time is short, but we can also do something. Please refer to page 117. Question 8, I guess. Page 117 of your study path. Let us look at question on IBOC Power Nigerian Limited, IPN. I think question 8.
Yes.
Okay, page 117, question 8. Let's see, 15 minutes. IBOC Power Nigerian Limited, in brackets IPN, is a power utility company providing power distribution services to the public and businesses of southern Nigeria. The company was formed when the government-owned Power Holdings Company of Nigeria was broken up into regional utility companies, one of which was IPN, and sold into private ownership over 4 years ago. As a vital utility for the economy of Nigeria, power services are a government-regulated industry. The regulator is primarily concerned that IPN does not abuse its monopoly power in the regional market to unjustifiably increase prices. The majority of the services, in bracket 80%, are controlled by the regulator, who sets an acceptable return on capital employed level. and ensure that pricing of IPN within this area does not breach this level. The remaining services, such as provision of meters and contract repair service are unregulated. IPN can charge market rates for these. Regulators calculate return on capital employed figure based on its own valuation of capital assets being used in regulated services and the operating profits from those regulated services. The target pre-tax return on capital employed set by the regulator is 6%. If IPN were to breach this figure, then the regulator could fine the company. In the past, other such companies have paid fine amounting to millions of naira. The board of IPM is trying to drive performance for the benefits of the shareholders. This is new experience for many at IPM who left the public service 4 years ago in order to try to better communicate the objective of maximizing shareholders' wealth. The board has decided to introduce economic value added as the key performance indicator. The finance director has provided the following financial information for the year ending 30th September 2018. We have e-bulk power services, revenue from regulated services, non-regulated services revenue, total revenue, operating costs, operating profits for the company as a whole, finance charges, profit after tax, 25% rate. Then we have capital employed, measured from published accounts 2017-2018, measured by the regulator is also given. Note number 1, total operating costs for 2018 and 2017 we are giving. Economic depreciation we are giving. Tax paid, adjustments for deferred taxation we are giving. Provision for doubtful debts on the 2018 statement of financial position we are giving. Research and development costs not capitalized in the accounts. It's related to a project that will be developed for over 5 years. Okay, we have the cost of capital of IPN, equity 16%, debt pre-tax 5%. We have the capital structure given. If you look at this question is not materially different from the question we solved before. Examiner says, evaluate the performance of IPN using economic value added, 13 marks. This question is almost the same with the question we solved in question 6. Let us see if we can do this in 10 minutes. So if you are faced with question of this nature, state your formula for economic value added, then proceed with your working. Once you know what to do, You don't need to waste time. Suggested solution. Suggested solution. A, calculation of economic value added. I will state the formula. Economic value added is calculated as NOPAT minus bracket adjusted capital employed multiplied by my work. So my working one, calculation of NOPAT. Now remember, you are going to calculate for the most recent year. In this case, we are going to deal with 2018. Go to the financial information, please. Pick the profit after tax for 2018. Supply the figure, please. Hello?
Aye. Okay, profit after tax. We have 17.75.
For 2018?
Yes, sir. 17.75.
17.75 million. Thank you. Items to be added.
No depreciation.
It's not
No
possible. Go
depreciation.
and look at.
Okay, yes, we do. We do. There's depreciation of 29.5.
Add back 29.5. Now check. Do we have provision for doubtful debt?
Provision for doubtful
One,
debt.
sir.
Yes.
How much?
Yes,
1.0. Now check. Do we have provision for the VAT taxation? Look at note number 3. Please, we are waiting.
0.25.
0.25. Now check. Do we have non-cash item for 2018? Others can also check.
Yes,
Yes.
we have
3.50.
3.5.
3.50. Do we have research and development cost for 2018?
Yes, we have 6.0.
Please add back. Do we have finance charge for 2018? That is interest
Yes,
net of tax.
Yes, we do. 11.5.
So the finance charge was 11.5 billion. Now net of tax. Look at the working. 11.5 multiplied by bracket 1 minus. What is the tax rate? Check the income statement.
It's 25%.
25%.
Minus 0.25. Please compute interest net of tax.
0.557 times 11.5. 8.625.
8.625. There's no goodwill in this question. These are the items to be added back. Somebody can do the addition for us and share. Items to be deducted. Items to
I
be...
got 48.875.
What do we have here?
I got 48.875.
48.875.
8.875. All right, thank you. Items to be deducted. Go and check. Do you have economic depreciation? Look at note number 2.
Yes, we do. 41.5.
This will be deducted. Then development cost not capitalized. It relates to a project that will be for 5 years. Is that not, please? Look at note number 4 or 5.
So research and development is not even capitalized in the account.
Good.
It relates to a new project that will be developed over 5 years and is expected to be of long-term benefit to the company. 2018 is the first year of the project.
So we need to amortize this cost. When we say amortization, spread the cost for the number of years the benefits will be derived. This cost was incurred 6 million, and it is for a project that will be beneficial for 5 years. So 6 million divided by 5 years. What is the annual amortization cost?
1.2.
1.2 million.
1.2. 1.2 million. These two items will be deducted. 41.5 plus 1.2. That becomes 42.7 million. You can now get your notepads. Look at it, 17.75 plus 80 plus 48.875. Let's add these two together. Then less 42.7. That will give you your notepad.
23.93.
23.9.
9 what?
93.
Approximately 93.
925, is that not?
95, yes, yes.
That is in billion. You have gotten your notepads. Next. Second working. Get your adjusted capital employed. You are going to pick opening capital employed. Now go and check the question. You are giving capital employed based on published accounts. You are also giving capital employed based on regulator valuation. For the purpose of requirements A, you are going to use capital employed based on published accounts. Because here we are interested in the valuation, in evaluating performance of the company as a whole, not whether regulated business or unregulated business. We are interested in the performance of the company as a whole. Now you are going to pick opening capital employed. Remember, you are dealing with 2018. That means our opening capital employed will be the closing capital employed for 2017. It was closing for 2017. It becomes opening for 2018. So what is the figure? Check.
318.5.
318.5 billion. Now, look at the question. Do we have non-capitalized lease assets?
We are told that research and development is not capitalized in the accounts. Okay. We've used that one already.
We don't have non-capitalized lease assets. Next, go and check. Do we have non-cash item? Yes, we do. 3.5 million. Also check, is there increase in provision? Look at that note. Provision for doubtful debts. Note number 3 or 4.
Yes, we are told that the doubtful debt was 2.25 on 2018 statement.
Now
On
compare
the
this
total
with the
operating cost,
provision you have in the income statement.
we have 1.0. So there's an increase in provision of
Thank you.
1.25.
Compare the two figures. What is the increase in provision, please?
1.25.
1.25. That will be added by doubtful debts. 1.25. These are the two items based on this question. These are the two items to be added back. That will give me 4.75. In this question, there is no decrease in provision. So you can get your adjusted capital employed. Adjusted capital employed. Please sum up.
That's 323.25. 323.25.
Thank you. Let me take like 10-15 minutes of your time. The last working is your work. Our work without wasting time. The formula is cost of equity multiplied by percentage of equity plus after tax cost of debt multiplied by percentage of debt. Go to the question, please. What is the cost of equity you are giving? %16%. The time is very scarce now. What is the percentage of equity? Hello?
Percentage of equity is sorry. We are told that the capital structure is 40 equity, 60 debt.
So equity is 40 plus. What is the cost of debt? You are giving the question.
The cost of debt is hold on. Cost of debt is 16%. Sorry, debt is pre-tax of 5%.
So the pre-tax is 5%. Now calculate after tax. To do that, you can do it here. 5% multiplied by 1 minus the tax rate, 0.25. Close this bracket. Then everything multiplied by, what is the percentage of debt? 60%. 60% debt. Please work this out. What is your work? Please work this out. What is your work?
One 0.75. I got 0.0865.
All right. Once you know how to apply calculator, the work is 0.0865. In percentage, it becomes 8.65%. Now you can determine your EVA or EVA. The economic value added is equal to note part, working one, 23.925 billion minus, open a bracket, adjusted capital employed, 323.25 multiplied by what? 0.0865. Please compute your economic value added. Is it positive or negative? Your answer should give you negative.
It's negative.
4.036 billion. Your answer should give you negative 4.3. It is 4.034 billion. What will be your comment now? This company is not doing well. Negative ever, 4 billion. We are being reminded that it's 11 o'clock. But please just give me like 2 minutes. I'll round up. The B part won't take 5 minutes anyway. That is the A part. Look at the B part for 7 marks. Assess whether IPN meets its regulatory return on capital employed targets and comment on the impact of such constraint on performance management at IPN. So we want to compute regulated return on capital employed. That is based on regulated services now. Look at B. Look at requirement B. Regulated return on capital employed. The formula becomes regulated operating profits divided by regulated capital employed multiplied by 100. Go to the question. Let's pick this figure. Look at it. Regulated operating, look at it. Regulated operating profit. 23 billion. I'll pick. Next. Capital employed by regulated services. 389.5. I can compute now. 23 billion divided by 23 billion divided by 389.5 multiplied by 100. Please compute the regulated return on capital employed.
5.9%.
5.9%.
And 8.65.
Is the company meeting its regulatory targets?
Yeah.
The regulatory target is 6%. Look at it, it's in the question. Regulatory return on capital employed target is equal to 6%. Is the company meeting its regulatory return target?
Yes, sir.
It's not getting to that point.
If you approximate 9, it will be 6. 5.9 is
the major concern is that you must not exceed 6%. If you exceed 6%, regulator will fine you penalty.
okay.
But the comment is still there. We are done with the question. That means most of the services of the company is controlled by the regulator. It's being regulated. You cannot charge price anyhow. That means your performance, your profit performance is being regulated. You cannot make profits the way you like. Regulator said, the regulator is saying that for the regulated services, which is 80% of the services, you cannot charge a price beyond what the regulators have set, so that you don't exploit the people unduly, because it's electricity you are supplying. If you charge any price, you can exploit the society. Government is trying to regulate the amount you charge, and these regulated services constitute 60% of your business. That means your profit is being regulated. You cannot make profit as you like. You only have control over unregulated services. In this case, for the company to improve its performance, the company needs to focus more on unregulated services, which is the provision of meter services and repair contract services. All right, thank you for your time. It's a time well spent. We have solved 2 questions on this environment. Any question, please? May God give us a better understanding.
Amen.